The PCE comes out tomorrow, so we have to talk about inflation outlook. I have that projection ready for you. And then also, what can we expect coming up for us in the markets? Looking from here forward, big video, lots of good information. I'm Dr. Stock, Doctor of Education, and I was riding my bike the other day, almost ran into the side of a parked car when suddenly it moved out of the way. What kind was it? A Dodge. The Fed's been talking about possibly raising rates again. Any news we get that actually refutes that, the market rallies. Any news that increases that likelihood that we see further rate hikes, the market tends to pull back a little bit. Well, I developed a lot of perspective around this, and I'm going to share it with you, especially where inflation is concerned, where I see it going, what it means for the Fed, and what it means for the markets. I put a lot of work into this video, and I really do hope that you appreciate every bit of information that I have, because I believe that it is really good for knowing what to expect on the horizon. Down in the description of this video, I will tell you later how you can get up to 16 free stocks using my link for Moo, and then also my Patreon link you can find down in the description as well, where I put all of my research. I also have my private Discord over there, my weekly watch list of stocks, my buy and sell alerts, including the options plays that I put out there. Go ahead and check that out. For right now, let me share some of the work that I've done with you for this inflation. So I'm, like I said, super excited to bring this here for you. So the very first thing that I wanted to know, more recently, January through June of this year, looking at the month-over-month change that we would get based on that. And really what I did was I did something called linearization. You don't need to know the word, blah, 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 boring math stuff. So let me take away the fill on this box right here, and we'll see, there we go, 0.21%. So that 0.2% month over month, which annualizes out to about 0.24 to almost 0.25, either one of those two values, which puts us about where we want to be. That's what we've seen this year when we look from January to June, and that's even an overestimate because of what we have. So it's actually showing signs of slowing from there. But we'll work with that number for right now. So when we look at June's percent that we had year over year, by the way, which is actually when we look at June of 2022 and July of 2022, we actually had a steep rise up to June and then a drop into July. So this is also an important number to look at. So that was actually 3% when we look at that year over year number. Well, July of 2022 dropped down further. However, now we're up here. So what that means is that since July dropped down, that's a bigger gap between them. So that's actually going to be a bigger year over year number that we have. So even if we go nowhere from June to July of this year, we're at 3.1% already. Now, mind you, we already see the month over month change at 2.1. So if I go over here and take a look and see what that looks like and zoom in on that for you, when we put that on top of June of 23 to July, that means that there's that 0.2%, which means that we get a headline reading of about 3.3%. And honestly, I wouldn't be surprised to see that come in at 3.2 instead of 3.3. And you guys can see what this looks like when I extend it out over time if we stick with that 0.2% being about where we're at. And why would I do that? Is there any evidence that supports it? Well, if we look over 2022, I highlighted it in red here for you, May and June, October, and then January of this year. Those were the only high months that we have, and everything else that we have is on trend. And so the next thing that I wanted to look at, and we'll get to these in a moment here, but the next thing I wanted to look at was the main drivers of inflation across time. So back in 2022 into early 2023, and then currently where we happen to sit. So let me take away the background of this. So here's 2022, the main drivers that we have for all that inflation that you saw, all that red highlighting that we had, excess demand for goods and services. So we had supply chain issues and outstripped demand for the supply that we had. And then services, people weren't working because of what happened with all the job losses and everything. We were hurting for those sort of services. Plus there was pent-up demand coming out of the pandemic. So between not having people to fill the jobs to handle those services, and then on top of that, all the excess demand, that was really put pressure on the service side of things that we're just starting to see that ease. I'll talk more about that later. We also had large wage increases because employers could not get workers. So they had to keep on increasing those wages until people were incentivized enough to actually come back to work. So another main driver that we get for inflation in 2022, cash-rich consumer from stimulus and deprivation. Like that's what I mentioned before about just that pent-up demand that we had, that deprivation of going out and having different goods because of supply chains. So they had to pay more for what they could get a hold of. And then also the deprivation of actually being able to go out and do things, travel being one of those big things that we saw in 2022 that really drove that inflation. And then we also had heightened inflation expectations. Some of that was tied back to what we saw with the deprivation and the stimulus and the supply chain, and then also what we saw with the labor shortage and what that meant for salaries and wages. So the strong housing market also went along with that we saw a lot of that through the low interest buying period, and that steepened the interest rate, I should say, steepened throughout 2022. And so that started, and we'll see that mostly more now. We see the effects of that, especially now that we're up over 7% for the 30-year mortgage rate. It really starts to crimp down on what we see in residential at the very least, but we're also expecting that to also come in with commercial real estate as well. And then there was also lower cost of borrowing money in 2022, not as low as it was throughout 2021 with the federal funds rate dropped to zero. However, that is where 2022 is where we had those rate hikes happening. So for January to February, what changed by the time that we got to there that really talks about those? Let me drop that away. Well, we had declining inflation expectations, and that helped to drive inflation up more because people were demanding more for goods, demanding more for services, because they were like, hey, inflation isn't so rampant now. Things are getting better for us, and that kind of helped keep a strong consumer, plus the higher wages that we're making. We had supply chain improvements. There's excess demand for services. Still, that service demand, we got to hear very early on in this year, we're still hearing about that excess demand for services that is outstripping the supply that we have for those services. And then the higher cost of borrowing money than we had throughout most of 2022. So even though we see a little bit of a resurgence, we're still starting to kind of sets the tone for what we see throughout the current inflation drivers that we have right now. So let's pop that down. So this is following what follows January, February. So this is March onward. That service supply and demand is nearing equilibrium. So that service inflation that we were waiting to come down finally is starting to show signs of that. High federal funds rate. We've heard repeatedly that we're currently at restrictive levels, and we're seeing that restriction take place, and we're seeing that play out in the inflation numbers as well. Higher cost of borrowing money. Federal funds rate just astoundingly high right now, and yet they still keep on talking about it. Credit tightness also, from Jerome Powell himself, said that credit tightness kind of serves as a proxy for increased federal funds rates. So that has taken the place of some of the federal funds rate hiking that we would see. We have reduced wage growth. So wages might still be increasing, but not nearly as rapidly as we saw throughout 2022. And that also goes along with the softness that we see in the labor market. Plus, we have student loans, even though that's not current, that's coming up for us. It's still something I think is also going to really weigh on the outlook for the consumer and the behavior of the consumer. That it is something that continues to drive inflation in a downward direction that we're at. And we'll see if we end up really, have we returned back to normal inflation levels? Are we going to continue to be at those? Are we going to see them drop us down below that 2% average inflation that they're talking about? And honestly, from where we're at right now, there's reason to say that we actually could be there. So let's go back to those numbers just real quick. There we go, July through January, what I have projected starting tomorrow all the way through the beginning of next year, and what we'll see. Now, mind you, this would take us all the way to February's reports. Well, February is the month that the January report would be. It'd be end of February that we would get January's numbers. But still, look what that means annually. So we go from 3 to 3.3%. So if we see that 3.3% come out, it is expected. It is priced in the markets. We'll look at the forecast in just a moment. But based on my projections, I'm seeing pretty much the same thing the other economists do, and Trading Economics, I'll bring that up there, forecast pretty much the same thing. By August, we start to tick back down, and then we just continue that steady drop. And by the time we get to January of 2024, that's from that big step we took up in January 2023, January 2024 finally adjusts us to that level, and we get a big drop to the point where we're in that mid twos instead of being closer to 3 from where we're at with a 2.9. Might as well call it 3% at that point in time. Whereas here we're like, mid 2. And then where does it go after that? Well, it depends on how long they keep those rates higher for longer, and the credit tightness that we see, the ability for the consumer to remain strong, or I should say the strength of the consumer. There's a lot that goes into it. So we're going to have to watch that. Labor market, I think, is going to be one of those things that tells us a lot about what's going on. And the Fed might be getting what they want to see right now, reducing the chances of increases to the federal funds rate. However, I do worry from there that it's not just that we're actually going to see too many of those layoffs happening, and we're going to see a shrink in the number of jobs and the number of jobs available. And that's something that can most definitely weigh on us as consumers if there's no consumers to spend, or less consumer spending to happen because fewer people have jobs, plus the student loans on top of it. I don't know how we really avoid having decreases to these numbers, or at least at the very most holding steady. I think at the very most we get a decrease. At the very least we hold steady with these numbers here. I don't see resurgent inflation at this point in time. So let me drop that down, and we're going to bring up trading economics. All right, so a quick look at today. GDP growth rate, quarter over quarter, second estimate, 2.1. The expectation was 2.4. So we already see that we missed expectations on that one. And if we scroll down from there, you can actually see what we have also for quarter over quarter. We went from 4.1 in quarter one to this second estimate that we get down to 2.5 for those prices for the PCE. And if we go to core PCE, 4.9 down to 3.7 when we watch those drops take place on these second estimates that we get. So again, missing expectations there for the core. And then we also, when we look up here, we miss expectations on there as well. We're to the downside on both those things. So let's scroll down to tomorrow, where we actually get personal income and outlays. Now, mind you, we also get challenger job cuts. That's going to be impactful as well. Remember, I mentioned the labor market in that. And then when we look at core PCE month over month, 0.2%. And then when we look at that for PCE prices for month over month, there's the 0.2, which is the same thing that I showed you through calculating based on linearization. So that's pretty much what I see for that consensus. If we come in under that, excellent. I think there's a further market rally waiting for us. If we come a little hot on that, 0.3, not a big deal. Really, that headline number that they're saying 3.3 or 3.2, which I also have coming in at 3.3, that's the one that might show some pain if we come in at that, but again, could possibly be priced in already. So if we beat those numbers to the downside again, that could be further upward pressure on the markets. About the federal funds rate, right now for September, 90% chance. So we're actually climbing to that no rate hike, and we go out to November, just under half a chance that we see 1 to 2 rate hikes by that point in time. And I can tell you, I just don't see it happening. And here's why. So let's go over to PCE. So this is going back to May of 2014 all the way to present. And you can see this is what was typical, what we had leading up to the pandemic. Since the pandemic, you can see starting all the way back in November of 2020 and then forward from there until January 2023 is really where we had the increase. Actually, we started going concave down as soon as February 2022, but certainly since July of 2022, we have this sort of shape, which is a deceleration in the inflation numbers that we have. And then when we go to the core values for that, it carried on a little bit longer. And why did it carry on a little bit longer? Well, for core, we take out food and energy. So we had some of that, the food values for inflation coming down for us sooner. We take food out of that equation. And also we saw some softness in energy as well over that time. And well, that explains why we saw a little bit more of a deceleration in inflation there. And here we're starting to see signs of it, yes, since January, and really flattening out in May into June, but that's only 2 data values. Now, even more convincing than that is when we look at the real personal consumption expenditures for goods. When we look at it in terms of goods, we actually peaked when we go back here. And when we say real, this is inflation adjusted. So when we adjust for inflation after March of 2021, so actually when we get to May 2021 until present, we're pretty much flat for goods inflation. Like, it hasn't happened. When you adjust for inflation, well, inflation comes out of it. Look before when we saw those inflation adjustments that you actually have growth with personal goods. And then when you take out the inflation or adjust for that inflation, well, we don't have the increase that we did before. And when we go over to services, you can see what was typical. You can see the drop off in the pandemic and the quick rapid rise that we had back in the pandemic, but going all the way back to July of 2022, maybe you can even argue back to March of 2022, somewhere in there for services, we also pretty much returned back to trend. So when we adjust for inflation, the growth that we're seeing in personal consumption expenditures is right in line with where it should be. We can actually draw a line and connect those two things, and we're pretty much back to normal already, even if the Fed doesn't choose to see it that way. Now, I will bring up Moo here in just a second. But the next thing that I'm going to show you are the inflation-adjusted NASDAQ 100 and the inflation-adjusted S&P 500 to see how do we compare the markets now versus where they were back at the end of 2021, where the market peaked for both the S&P and for the NASDAQ. Well, specifically the NASDAQ 100 is what we're looking at. What does that look like when you adjust the two of them for inflation? And then we'll actually go over to Moo from there, and I will show you on the charts what the markets look like now and talk about what that looks like presently or currently in the near term and what that could mean for us over the longer term as well. and I think it's going to be very insightful for you. Here we're looking at the inflation-adjusted S&P, and you can see right here, this is December, January 2021 into 2022. We peaked, and then we sold off, and when you adjust for inflation, we only made it about halfway back up. So that's kind of neat to see that the markets haven't rallied nearly as much as we thought what they did when you adjust for inflation. And then when you look at what we have for the NASDAQ 100, again, we have the peak that's November, December, and we have corrected over halfway, but we are nearing these peaks that we have from a technical analysis standpoint. Now, mind you, some of this that we see, we can explain some of that away by AI and some of the big tech stock rallies that we've had, and that should be something that at least for right now outperforms what we would have with the S&P. We should, because there's a lot of bank stocks in there which haven't been great for us. So the S&P should be underperforming even when you adjust for inflation versus the NASDAQ 100, which has the tech stocks with the AI tailwind on top of it. So some of that increase that we saw when we adjust for inflation should be there and can be explained by at least some of that for the NASDAQ. So let's go over to Moo. And remember that down in the description of this video, I told you you can get up to 16 free stocks using my link. And all you got to do is deposit $100 or more to get those free stocks, $50 cash reward at every tier, 5 free stocks for $100 deposit. If you deposit $1,000, you get 15 free stocks. 5,000 gets you 16 free stocks, because that last stock that you get, or part of those stocks that you get, is free share of Tesla or Google. And if you like my commentary, want to hear more of it, see my buys and sells, my watches to stocks, my research that I put out over there, including my NVIDIA stock price prediction, NVIDIA earnings projection, that's all of it also available over at the Patreon. All right, so I have the SPY brought up for you, which tracks the S&P, and you can see we don't have that same high peak from 2021 when we take out the adjustment for inflation. So right now, like, remember for the S&P, when we did adjust for inflation, we were only about halfway to the top. So that means that we do have some more room to run here before we really start peaking out, that we're not seeing the same exuberance that we saw back at the end of 2021 into early 2022. So keep that in mind as we look at this, and we have probably another 2 to 3% to run in this SPY before we start to get near this top, before we run into real resistance, probably by about 464. Maybe we push up even to that previous high that we had right around 468, 469. We're going to have to watch and see on that one, but it is possible that we do reach that. Let's go over to the Qs. So when we look at the Qs, you can see the channel I have drawn on here, which is very similar to what you can do with the SPY, by the way. This tracks the NASDAQ 100, and we looked at the inflation-adjusted version of this, and we were probably about 2/3 of the way to the top on this one. You can see when you take out the inflation adjustments, you actually get much closer to that, and we do, even though we're sitting at resistance right now, if we break through it, we have, again, another 2 to 3% that we could put on top of what you see right now, that we could possibly see this go up to about 387, 388, and from there, if we can continue to overtake this previous peak that we had, then we get to move on from there to about 396. So we'll see if that momentum can carry out. The one thing that I'm looking for in terms of that momentum is what we get through further economic reporting and reduced risk of further Fed rate hikes, and also being able to stay elevated enough in those jobs reports to actually have sufficient tightness but not over tightening. So that's really threading the needle there. And then on top of that, what we're looking for when it comes to inflation data is that we do want to see it continuing to cool and coming back down to normal levels. We don't want to see it go down too low for too long, where it starts to look like we're going to start running into deflation and possible recession. But going back to what I said before, we were in a low interest environment, and we also had tons of economic stimulus on top of it. And I don't know that we see that same exuberance coming out of it, especially when that was sort of record setting for us in 2021 in the first place, through the inflation adjustments and the changes in environment that we're in right now, and the macroeconomic events that we're looking forward from here, and just everything that surrounds the markets. I think that this is going to be a slower climb for us, which means some more volatility ahead of us. And so when we see those sell-offs happen, for me, that's where I think the really big opportunities come in. A lot of the excitement that we share over at the Discord, which is part of my Patreon, link down in the description, that's where that excitement really comes in. When things start to get near the top, it's like, it's fun to watch your portfolios go up, but what's not fun is having to worry about them falling back down again. That's more of that strategy that we can talk about. Now, for those links down in the description, sign up for Moo, make your deposit, get your free stocks. Also that Patreon, if you want to see what I'm buying and selling, the opportunities that I'm taking advantage of, the opportunities that I find in the market, along with my research and what in the world is going on with NVIDIA. That's a separate video, but I already do have it down in the description. Just find that link for the Patreon and sign up. I am Dr. Stock, Doctor of Education. Remember, my friends, that learning is earning, and we'll see you in the next video.